It is likely to be shallow indeed, and clearly that strength of the labor market makes the job much more complicated for the Fed. I mean, employment is a lagging indicator, so I'm still looking for some slowdown, some deterioration of the labor market down the road later this year. But it's been remarkably strong. When I look at the quit rate that we got earlier this week for November at 2.7%, that's still very high. The average of the past 20 years is like 2%. So that's a very tight labor market, much too tight for the Fed to get comfortable about the pullback in inflation. So they have more work to do. And that resilience of the job market complicates the Fed job. There is talk, that companies are basically holding to their employees because they are concerned that once we pass the shallow recession, it will be hard to hire again. So that could change the dynamics of the job market through this slowdown, and again, really makes the Fed's job harder.
Yeah, you've also pointed to a possible cut then in those interest rates, particularly in the latter part of 2023. But is there a worry then of inflation creeping back up? If not late this year, if not early next year then as well. And what does it mean for that long-term 2% inflationary figure that keeps getting touted still?
Yeah, I don't think they're going to change that target. I think it's too early to position for a pivot of the Fed. I do believe we may see a cut later this year, but very late this year. I don't think that process starts early in the autumn. So I don't think from a market point of view, we should position for a turn from the Fed too quickly. Right now, the Fed officials, the FOMC members, do remain concerned about upside inflation risk. If you look at the inflation diffusion index that they have in the FOMC, it shows that overwhelmingly, Fed members are concerned about the upside of inflation. So the risk is that they tighten more than expected, and that they do not cut as quickly as expected because they want inflation to get down, indeed.
Looking a little bit more closely at the market reaction so far, yesterday we saw investors price in more rate hikes from the Fed on the back of those stronger employment reports, the ADP and the weekly jobless claims. What about market reaction to today's non-farm payrolls report? Are we in a position where a strong number is going to be bad for equity markets?
I would tend to believe so. We've had a pretty strong start in equities this year. I think the market increasingly is pricing that fairly rosy scenario whereby inflation would cool down pretty quickly, and we would get a soft landing, not a recession, but a soft landing. That's clearly the perfect scenario. I think it's going to be difficult. My concern is that job data remains strong. The market then continues to worry about the Fed, and again, it's too early to position for a pivot. When you listen to the to Powell following the last FOMC, really, that was the concern, that inflation was still way too high and that the labor market was still red hot. So any strong employment number means the Fed remains concerned, they tighten, and potentially they over-tighten. Already, policy in our book is in restrictive territory. Any strong labor market number means that they might go further up in the restrictive territory.
Really interesting. You think they're already in restrictive territory. I also found your comments around the dynamics within companies interesting, that companies are holding on to employees perhaps because they think the recession is going to be short-lived and shallow. What is going to crack the labor market, if anything? I mean, over the last couple of days, there's been a lot of focus on the tech sector in the U.S., Amazon announcing tens of thousands of job cuts. And we know a number of the big U.S. tech players have been making plans to reduce headcount. But how much of a dent are those tech layoffs going to have on the broader labor market? And again, just what is going to crack it?
No, that is a big question mark indeed. How is this labor market going to believe in that slowdown? And is it going to believe very differently from what we have seen historically? Possibly because I think companies realized through COVID that they were a bit too quick laying off people, and after that it was hard for them to hire them back. So that may change their behavior in this slowdown. What will crack the labor market eventually, I think, is lower profits. The market is not pricing that yet. The consensus is still looking for a small increase in profits this year. That's very optimistic. If you look at leading indicators, they're very clearly pointing towards a decline in profits, probably something around 10%. And when those profits numbers start to deteriorate, it will be a trade-off for companies, between making some savings, but also making sure that they are positioned and they can benefit from the recovery when it comes. That's a trade-off that clearly blurs a little bit the outlook for the labor market. But I think we will see some cracks eventually, indeed.